This point of time, we believe that once a company grows to a certain size, there is additional cash flow that comes in.
So what are the criteria that Kotak Mahindra look at?
We look at 3-4 things very critically. So business, management and valuations.
Large caps are called the elephants of the market. But the problem with elephants is they are slow.
Just a question of perspective. I think most investors are blinded by what has happened in the last couple of years.
Then what should we choose ideally? Active funds or the passive funds? What actually triggers this behavior?
Just for example, if you're paying cost of a Mercedes car to a Maruti car, it's not a great value.
How to identify this bottom?
So we don't look at prices, we look at valuations.
Globally, every day we get a new war happening. Where do you see the Indian economy going in the coming years?
India, historically as well as even at this point of time, has been more domestic-oriented economy as compared to many others which are export-oriented.
One question that I usually get is, कौन सा share करें? So if somebody asks you that question, what is your appropriate answer? Alright, another day, another podcast on investing with Dhan. एक ऐसा चैनल जहाँ पे हम अलग अलग गेस्ट को हर बार लेके आते हैं आप सबके साथ इंटरेक्शन करने के लिए, अलग अलग चीज़ों को शेयर करने के लिए, मार्केट इनसाइट्स को बताने के लिए. You're with me, अंश आर हिरन, और आज हमारे साथ एक बहुत स्पेशल गेस्ट, द CIO ऑफ कोटक महिंद्रा AMC, मिस्टर हर्षा उपाध्याय. हाय सर, वेलकम टू धन्स पॉडकास्ट.
प्लेजर.
सो आज बहुत सारी बातें करने वाले हम अलग अलग फंड्स के बारे में, एंड स्पेशली जो आपकी एक्सपर्टीज है और जिस चीज़ को आप बहुत ज़्यादा प्रमोट भी करते हैं, दैट इज़ लार्ज कैप, राइट? लार्ज कैप एंड मिड कैप एंड वैल्यू इन्वेस्टिंग, इन सब के बारे में बात करेंगे. बट इन सब कॉन्वर्जेशंस में जब भी हम शुरू करते हैं, मेरा सबसे पहला क्वेश्चन जो होता है, वाई, राइट? सो इफ आई स्टार्ट विद दिस क्वेश्चन कि वाई लार्ज कैप फंड्स और वाई लार्ज कैप स्पेसिफिकली?
It's not that we always promote large cap funds or large cap tilted funds, but at this point of time, we believe that from a risk return perspective, large cap funds or the funds which have higher tilt towards large caps have a better risk reward ratio. Simply because if you look at the valuations today, across the board valuations are higher compared to historical average range of valuations. But when you look at it from just the large cap perspective, the valuations are slightly above that historical range. Whereas when you look at it for mid caps and small caps,
Correct.
these are at 30 to 40% premium as compared to historical average valuations. So given a situation where earnings are also moderating, we should be careful about what valuations we pay for the stocks or the portfolios that we invest into. In that context, at this point of time, since large caps on a relative basis are trading at a valuation which is much better compared to mid caps and small caps or mid cap and small cap funds, we want to promote large cap or large cap oriented funds. However, if somebody wants to have exposure to mid and small cap funds, they are most welcome, but their horizon has to be much longer than what they usually look for, or they should be doing disciplined SIP kind of investments rather than lump sum investments. In case one is looking for lump sum investments, given the current context, it's better to do it in large cap funds.
Got it. So you talked about valuation, right? So what are the criteria that Kotak Mahindra AMC and you look at while investing in a particular stock or in a particular sector? Like, how do you analyze the valuation of a particular sector, or you understand ki if this sector is undervalued or overvalued, or this particular stock is undervalued or overvalued? At the same time, what a retail investor can do to identify the same?
First of all, for a retail investor, I think the easiest thing is to invest in mutual funds and leave that headache to a professional team which will manage researching stocks and constructing the portfolio.
Okay.
Right? And if you are if you are looking at investment philosophy, because I don't want to just talk about valuations. Valuations is one part of the overall evaluation that we do. Our investment philosophy is to invest which are focused on growth at reasonable price.
Yeah.
What do we mean by growth at reasonable price? The tilt of the portfolio will be towards growth stocks, but we will also be conscious about valuations or the price that we pay for those stocks. That's the investment philosophy or the investment approach. We look at 3-4 things very critically.
Okay.
First and foremost, business. What kind of business are we investing into? Whether it's a scalable business, whether it's a proven business model or not. What has been the track record of that business over the cycles? Then comes evaluation of the management. Management is also equally important to run that business in terms of what is their vision, what is their execution track record, and most importantly, what is the capital allocation policy of the management. Because once a company grows to a certain size, there is additional cash flow that comes in, and how do they use that additional cash flow to increase their market share, increase their standing in the market, and what are the returns that shareholder can expect from those investments, whether they're superior to existing investments, inferior to existing investments, or it's in the same fashion. So there are many such decisions that we need to evaluate on the management side. We also look at whether management is aligned to minority shareholder interests. That's very important because in Indian context, there are large promoter groups which are managing the businesses and their interests need to be aligned with the minority shareholders, which typically is a mutual fund investor is. Right? And finally, in all these cases, the final filter is valuations. Valuations will be seen. There can be a business which is very, very strong, very good. Management may be very good, but if the stock is not at valuations that are comfortable to us, we may not put it into the portfolio at that point of time. So business, management, and valuations. These are the 3 critical factors that we evaluate whenever we choose a particular sector or a stock into the portfolio.
So there's no particular criteria like, okay, the PE should be like that and the PV should be like that, or any other ratio or any other balance sheet value should be in a particular range.
We do complete financial analysis, but I don't think it will be right to say that at a certain PE, we will be investing in all stocks.
Yeah.
For example, a stock may be trading at X price to earnings multiple, but if business is not showing any growth, for example, it may continue to trade at that multiple or even lower multiple going forward. So you always need to marry business valuations and management. You can't just look at valuations or just the business. Business may be very great, but if you're already paying very high valuation, just for example, if you're paying cost of a Mercedes car to a Maruti car, it's not a great value, right? So you have to remember that the business may be very great, but if you are not paying the right valuations, you will end up not making money. So you have to keep all these factors in front of you and then analyze. So just by looking at a price or a certain price to earnings ratio, I don't think you can invest that way.
All right, got it. So talking about the large cap, that you suggested they are the best pick as of now in the volatile market. Large caps are called the elephants of the markets, right? But the problem with elephant is, for sure, they are solid, right? But at the same time, they are slow, right? They're not going to run at a great speed. But that is not something which is true for the mid caps and small caps, which they are volatile, no doubt about that, but they give us a great opportunity for growth, right? You might have heard about this term called multi-bagger stocks. You don't find them in large caps. We usually find them in mid caps and small caps, right? So if we are aiming towards finding a multi-bagger, then do you think the large cap is the right pick then?
First of all, it's a myth that you can't find multi-baggers in large caps or you get very, very slow returns in large caps. It's just a question of perspective. I think most investors are blinded by what has happened in the last couple of years, especially post-COVID until about beginning of 2024. I think everyone is extrapolating that period to say that even in the future, it's going to be the same. But if you look at the last 15-year returns or 20-year returns, large caps, mid caps, and small caps have almost moved in a same range. Maybe 0.5 percentage point or a percentage point difference in terms of the CAGR returns, but it's not been too different. There have also been phases, because I have been in this business for 30 years now, there have been phases where small caps have underperformed large caps by 4 percentage points on a CAGR basis for 15 years. But many investors have not seen those data points or those market phases. They tend to believe that what has happened in the last 3-4 years is the reality. Some kind of a reality check has already happened in the last year or maybe 9 months, where mid and small caps have not given those returns.
Correct.
It's again coming back to the same thing. You will get multi-bagger when growth is very, very superior and also the valuations are very low. But now when you are entering mid and small caps, the valuations are not as low as what it was during the post-pandemic period. So you're not paying the same valuation, you are paying much higher valuation.
Correct.
Remember what I responded to when you asked about the valuations. I said today mid and small caps are trading on an average by about 30 to 40% premium to historical valuation.
Correct.
Right? So for that valuation to sustain, the earnings growth has to be similarly superior. If not, there can be a downside, which is what we have seen in the a few months of 24 and early part of 25.
Correct.
Right? So I don't think one can generalize and say that just because mid and small caps have done very well in the last 3-4 years, they will continue to do well for next 10 years. So always one needs to keep in mind the growth parameters as well as the valuations.
All right. We talked about SIPs and lump sums, right? So you said, okay, if you want to take part in the mid cap and small cap, then SIP is a better choice. But if you want to do lump sum, then large cap is going to be a better choice for everyone. Can you just elaborate on that point?
See, whenever the valuations are at attractive levels or at least closer to long-term averages, you can still do lump sum investments because the risk is less. In a situation like COVID bottom, the valuations were very, very attractive, right? So doing lump sum is a great way of creating wealth.
Correct.
Today, valuations are not the same. They have moved up, but they are closer to historical averages as far as large caps are concerned. So you can still attempt to do lump sum and still create reasonable wealth with a lower degree of volatility. However, mid and small caps are trading at 30 to 40% premium to those valuations. None of us know the exit valuations, right? You may be investing for 3 years, somebody else may be investing for a year, someone else may be investing for 5 years. Let's assume that somebody enters today and exits at long-term average valuations.
Okay.
Right? In case of large caps, then you are ideally going to get earnings related upside because over the next 3 years, for example, the large caps will grow at certain X percentage and that's what comes to you as returns. In case of mid and small, already there is a premium that you are paying. So you will not get the earnings growth related returns if valuations come down to average. For you to get earnings related upside, the valuations have to remain at 30-40% premium or they have to continue re-rating even after 3 years, which we do not know. And that's not a base case assumption. That's where at higher valuations, it's better to make systematic investments so that over a period of time, as market shows volatility, the valuations will also go up and down and you will create a portfolio which is at reasonable valuations. Otherwise, you will end up creating a portfolio at very high valuations of the market.
Then what should we choose ideally? The active funds or the passive funds?
Active funds. Active funds, because active funds at least have a window of opportunity to outperform the benchmarks. The passive funds, while they may be cost effective, but there is absolutely no chance of beating the benchmark. So when you make up an investment into a passive fund, you are already agreeing to get an underperformance against the benchmark. That underperformance may be small, but it is a guaranteed underperformance.
Because of the cost?
Because of the cost, because of the tracking error, rebalancing, all of those issues, right? Whereas in an active fund, we don't know the outcome, but at least that window of opportunity is open for an outperformance. And when you look at it from a longer term perspective, most mutual funds which are well managed have beaten the respective benchmarks. So I would say if you really are looking for an outperformance, at least you should keep that window open and hence you should come into active funds. And also active funds in many cases are not very, very different in terms of the cost structure. They are as good as some of the passive funds in many categories. There are funds which are with lower costs as well.
Got it. But when there are times of correction, a lot of people start redeeming their SIPs. It has happened a lot in the last 9 months as well. You might have faced that. What actually triggers this behavior? Because see, if you look at the calculations, right, SIPs gives you the best return when you invest them in a downtrend, right? When there's a downtrend going on, when there's a dip in the market, if you continue your SIP at that time, that's when you get the best returns that you're supposed to get from the SIP. But the moment people start looking at a little bit of negative returns on the portfolio, they start redeeming the SIPs. Right? So what actually triggers this behavior?
See, I think over a period of time, the market is also becoming mature. The investor behavior is also changing. If you look at last 3-4 years, I don't think Indian investors have got scared with the market volatility. There will always be certain set of people who will get scared in terms of market volatility, stop their SIPs or redeem their investments. But on a net basis, when you look at the monthly input number for the industry on the SIP side, it has been reasonably steady. And it's been continuing at around 26,000 crores for the last several months, despite the volatility that we have seen in the market. So I would say at the aggregate, we are not seeing any such trend, but there will always be X amount of people who will probably get scared whenever there is volatility. But I think I would like to, through your medium, I would like to tell those investors that SIP is conceived only for such investors that you should be able to beat volatility.
Correct.
Right? That is the starting point of an SIP. And if you get scared and if you go out, then you are not really using that SIP to good effect. So ideally, it should be for a longer term and you should do it in a disciplined way so that over a period of time, you build your portfolio at various price levels or various valuation levels. And since equities are long-term asset classes and since the underlying businesses are likely to do well, you will end up making better returns from a longer term perspective.
All right. So we talked about the SIPs, right? If you just invest them in a downtrend, or if you're like trying to invest in lump sum, it should be at the bottom, which gives you the best return. How to identify this bottom?
See, most investors look at index level or the price level of a stock. That tells you nothing. Ideally, you should be looking at the valuation of a stock or valuation of the index, which is what we as portfolio managers do. Right? That's why if you go back to what we discussed earlier, 3 critical things for portfolio construction: business, valuations, and management.
Correct.
Or business, management, and valuations. Valuation is always the last filter that we put in. So we don't look at prices, we look at valuations. For a normal investor, it's very difficult to understand what I'm saying. They will be identifying themselves with 25,000 Nifty, 80,000 SenSex, etc. But that 25,000 is coming at a certain valuation at this point of time. If next year it is at 25,000, the valuations could be very different. The prices are same, but the valuations are different because they capture what is 1 year forward earnings or what is the expected earnings of that year. So 25,000 in a year and 3 years later, again the 25,000 comes. It doesn't mean that it's at the same valuation. It could be very different valuations. That's what we try to. If you look at prices, you will feel that 25,000 is same as 25,000.
Correct.
Right? That's not the way you analyze stocks.
Previous bottom and the support level.
No, you need to see the underlying valuation. For example, if EPS of Nifty basket is 1,000, let's say, for an example, and if it is trading at 25,000 index level, then it's a price to earnings multiple of 25, for example.
Correct.
Right? But let's say 3 years down the line, index is still at 25,000, but the expected earnings is at 2,000. Let's say hypothetically. Then price to earnings multiple becomes 12.5, not 25.
Right.
But those who are looking at prices or the index levels will feel that both are same. Whereas 3 years down the line, you are buying it at 12.5 price to earning multiple, as against you would have bought it at 25 multiple today. So that's the difference. So that's what one needs to look at. Evaluate the valuation, not the price level. And for that, you need to analyze the financials. You need to understand how the businesses are doing, what can be the expected business performance going forward, and at what valuations you are comfortable to buy those stocks or buy that index.
But not everyone can do that, right?
That's why it's not that everyone has to do it by themselves, right? That's why there is a professional management. That's what we do for a living.
Got it. One more thing that I wanted to ask is, globally, situations are very, I can say, newsy. Right? Every day we get a news. Every day there is a war, a new war happening. Every day, world leader, wakes up and just tweets something and the entire market crashes. And here we are as a country, we are trying to keep a balance, right? Trying to grow our economy at a faster rate, as fast as possible, trying to do better than the previous quarters, right? Recently, our central bank reduced the interest rate as well. Uh, but amidst this global scenario, right, where do you see the Indian economy going in the coming years?
See, from a bottom-up perspective, India continues to do quite well. But yes, there are global uh, 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 global backdrop that affects Indian economy as well.
Yeah.
So to that extent, yes, there will be push and pull that we'll have to bear with. However, from a domestic perspective, I think the macro fundamentals are one of the strongest that we have seen. And even when others are struggling, especially post-pandemic, either in terms of inflation, either in terms of the slowing economy or various other issues, India has been quite resilient in terms of economic growth and continues to grow at roughly around 6.5% or so. Our inflation is quite moderate, below 3% at this point of time. And that's also one of the reasons why, as you said, Reserve Bank of India has cut interest rates in the recent times. So, and crude continues to be reasonably stable. I mean, let's not talk about what has happened because of Israel-Iran conflict in the last couple of days.
Correct.
But otherwise, broadly, it's been quite stable. So, if you look at our overall macroeconomic situation, I think situation is really kind of very, very strong and resilient at this point of time. And that's what helps India at this point of time to do relatively better than some of the other global economies.
Right.
And also India historically, as well as even at this point of time, has been more domestic oriented economy as compared to many others in the globe which are export oriented, which means that they are dependent on somebody else's growth, some other economy's growth for their good. Whereas India, while we also export some of our products and services, but our dependency is on domestic market, which continues to do better than many other economies in the world. And that's what has helped India to kind of wade through all of this volatility in the recent times when globe has been witnessing so many challenges.
So around 2.5 lakh crores is the amount which retail investors are giving every single year as an SIP amount, right? Which is actually strengthening the DIIs of our country. We used to say previously, actually can say about pre-COVID era, that FIIs control the Indian economy. But post-COVID, because of this inflow of capital, because of the SIPs, we are saying that okay, DIIs are much more stronger. They are capable of sustaining the Indian market's growth and the upward trend of the market. But the last correction that we saw was because FIIs were pulling out the money of the market, right? So are we actually independent in your opinion?
See, again, I think one should look at the numbers rather than just going by headlines.
Okay.
If you look at the numbers, in the earlier period of time, let's say I'm going back to global financial crisis or COVID time period, the market downside was in the region of 30%, 50%, etc. What was the kind of downside that we saw in the last 6 months when FIIs pulled out? And what is the amount that they pulled out? They pulled out $30 billion.
Correct.
So as a quantum, it was much higher than what they pulled out in many other market correction phases.
Yeah.
So a couple of things have clearly changed in the market, but I think not all investors or those who are linked to the market have recognized these changes in the Indian context. First and foremost, their dominance on India was very, very high when they held much higher quantity of Indian equities as compared to domestic investors. Domestic investors, as in mutual funds and insurance put together, at that point of time used to hold about 12% of Indian equities, whereas FIIs as a whole used to hold 24 to 25% of our equity, which meant that they held more, and whenever they bought or they sold, that used to create more volatility in the market. Point number one. Second, as you rightly said, SIPs were very, very small in the context of what global flows were at that point of time. So whenever they bought and sold, they used to move the markets more than Indians would do, because the component was much smaller as far as domestic flows were concerned. And the third part is, 10 years back, for example, there was no asset allocation product in the mutual fund industry. Asset allocation products are your balance advantage funds, equity savings funds, multi-assets funds, etc. These change their equity allocation from low to high or vice versa, depending on equity valuations, right? So what it means is, even if you assume hypothetically that there is no inflow into the industry and market drops 10%, let's say,
Right.
then equity valuation, assuming all else being equal, your valuations would go down by 10% and your equity component in these funds are likely to go up, which means that even without any inflows into the industry, they can support equities to some extent, right? So this was not possible 10 years back because there was no such category at all. There were no flows into these funds. So because of the three factors that I mentioned to you, the dominance of FIIs on Indian market has reduced over a period of time.
Okay.
So that's the reality.
That's a good part, actually. All right. So one more question that I have for you is, like, economy is growing, and of course the Kotak AMC is also growing, and the asset under management is also growing. So if we start from like 10,000 or 20,000 crores of AUM, and now around 5 lakh crores of AUM, how your role as CIO has changed? What all things that you have done for this growth in the company?
See, first and foremost, we have built the team. I think the team over the years has only got strengthened. When I say the team, for an outsider, fund manager is the visible face, but there is research which supports each fund manager. The entire investment team is supported by research.
Right.
So today we have the capability to cover almost 540 stocks internally, right? There is a large research team which covers all of these stocks on a continuous basis. When I say cover, they research these companies, they research the businesses, they make, they read the financial statements, they make financial projections, they evaluate the valuations, and make recommendation in terms of what is their pecking order or what kind of stocks can come into the portfolio. Then the portfolio manager decides to buy some of those stocks depending on the mandate into the portfolio. And there is a separate execution team as well, which executes our transactions in the market. So we have built capabilities across all these sub-functions within investments over a period of time. We have built that team quite nicely. In fact, last year we had zero attrition in the entire investment team. I think very few mutual funds can really talk about zero attrition in a year which has been such a wonderful year for the market. Obviously, there are more job opportunities, etc. But we have managed. We didn't have any attrition in our team. We have managed to retain the entire team. So that's one part. The second is the risk management, where we have built an institutional framework to manage the risk. Today we are there, tomorrow somebody else will probably manage. Right? In that case, it has to be managed in a particular framework so that the person who is managing it does not change the overall composition of the portfolio or style of the portfolio, is what we have built in terms of the risk controls. I mean, these are just few points, but very, very important points in terms of how we have managed to create that kind of consistency, whether it was a small side fund house or the current levels of AUM that we manage. So we have continued to do this with the utmost discipline across market cycles and irrespective of volatility. So we don't chase momentum in the market. We do what we are supposed to do in terms of fundamentally evaluating businesses, looking at their valuations, and constructing portfolio with certain manageable risk in the overall framework.
Got it. My last question to you for today's podcast is, you are a well-known personality in the market, and I am also a trader. So, and our family knows about it, right? So whenever we go to any function or any family gathering, one question that I usually get is, यार कौन सा stock खरीदूं, कौन सा share खरीदूं? So if somebody asks you that question, what is your appropriate answer?
So you don't have to worry about a single stock. You invest in any of the Kotak mutual fund products, you'll make money.
Okay. Perfect, sir. ऑलराइट, थैंक यू सो मच सर फॉर योर टाइम एंड बहुत अच्छा लगा आपसे इन चीज़ों के ऊपर बात करके, फंड्स को डिस्कस करके और SIPs और इन्वेस्टमेंट के मंत्रास को डिस्कस करके। एंड या आई होप आपको भी बहुत ज़्यादा मज़ा आया हो, बहुत ज़्यादा वैल्यू मिली हो, ये सारे जो इनसाइट्स हमको हर्षा सर ने दिए। सो या आपको कैसा लगा ये पूरा का पूरा पॉडकास्ट? लेट अस नो इन द कमेंट सेक्शन बिलो। अगर आपके कोई क्वेश्चंस हैं वो भी हमें बताइए, एंड आई रियली होप सर हमें हेल्प करेंगे उनको आंसर करने में। And on that note, thank you so much everyone for watching, and I look forward to see you in more such informative content. Till then, keep learning, keep trading and investing with Dhan, of course. See you guys. Subscribe to them.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.